Kia ora. My name is Katie Wesney, and tonight we're going to be answering the question everyone should be asking: how to make the most of these interest rate drops and make progress versus sleepwalking into the next high interest rate cycle. What I'm not going to do tonight is act like an economist and tell you this could happen or this could happen or neither. We're going to focus on the controlled actions that you can take because that is where the power lies. I've got 4 key ideas that I'll weave through this webinar tonight. Firstly, lower interest rates does not translate to progress. Secondly, when it hurts less, people get really comfortable and they are less likely to take action. I liken it to a lobster in a pot of water where you're turning up that temperature. Thirdly, this is your opportunity to make progress. Don't squander it. And fourthly, my challenge for you tonight is to really understand what are the key actions you're going to take or the key information you're going to take which can move the dial for you and your family going forward. Knowing and doing are 2 different things. We've got an action-packed agenda tonight. I'm going to keep it really tight. First, we'll go through what is our reality at the moment in terms of the mortgage infrastructure, external forces that could be holding you back. We're going to unpack together the real levers to get you ahead. So we'll unpack that strategy. And we're going to lean into, once we have that really solid foundation, how do we lean into wealth creation through leverage? That is a really important component of a really robust mortgage structure and strategy. And I hope to tie it all together with a good client story that will resonate with you, I'm sure. Please ask any questions. I am more than happy to help. We've got a Q&A box at the bottom. Submit them. My lovely producer, Jess, will collate them and we'll go through them at the end. Ask me anything. There's nothing I haven't heard before. So obviously what we can't go through tonight is your own personal circumstances. This is not a substitute for personalised financial advice, but I'd highly recommend you get some, and I can help with this. If you stick around to the end, I can share how you can get a discount on that. So you might be asking, who am I to give you advice on your finances? Big question. So I am the head strategic coach at Enable Me. So I have wonderful clients like you, but I also help coach our coaches nationwide. I'm also a chartered accountant. I trained at KPMG longer than I care to admit, and I've got many years in the accounting, finance, investment banking, and consulting industry. I'm a staff money columnist. I built and sold my own successful business. I've worked across Europe, US, and New Zealand. In this role, I'm a financial strategist. You tell me where you would like to get to financially, and I will show you the shortest route with the least amount of effort. That is my job, and I love it. We're all different, but there are key themes that most of us want. Choice, really important. We want to be sleeping at night and do the stuff that lights our fire. My goals are different to yours. I want to know that when interest rates are high, I'm safe in my home. I want to know that I am sorted for retirement, and I want to have the ability to help my kids on most days, unless they're being annoying. And in terms of our current mortgage reality in New Zealand. This is a really important date with us, for us in terms of the OCR announcement today, which we're going to unpack together soon and how that should reflect in your mortgage strategy going forward. 80% of home loans are due to refix in 2025. Most people will get a better rate. That means we have more money in our pocket. Question, what are you going to do with it? And most people are waiting to decide what to do. Should I fix short, long? And isn't that statistic interesting there in terms of falling behind on payments? It shows that there has been a lot of pressure, and I feel like we're all holding our breath. And inflation, if it doesn't go away, what will that mean to us? And if you have been feeling the pressure, the last few years have been hard. I understand. You've survived though. High five. In terms of first home mortgages, they've increased from 300,000 to 550,000 within the last 10 years. The differential, though, will mean that you will save more interest when rates go down. So, of course, it's been harder. We have opportunities, though. We just need to know how to execute on those. And if you hold a mortgage, these are some of the questions you're likely to be considering this year and dying for me to answer in today's webinar. We'll cover this as we go, but do you want to know a secret? Getting ahead isn't about timing an interest rate drop. So some of the questions you will be asking yourself, and I'm going to cover them off, should I refinance to another bank or stay put? Should I fix or float? If I fix, how long for? Could I structure my mortgage better? Likely. The most important question is, how fast could I be repaying my mortgage? The default mortgage term in New Zealand is 30 years. If you pay your mortgage off over 30 years, you will repay 2-3 times what you borrowed. So 500,000 repaid over 30 years, you can repay up to 3 times back to the bank, 1.5 million. And it is not year 15 that you start paying back more principal than you do interest. If you pay off that mortgage over that set term, it's actually year 23 that you start paying back more principal than you do interest, which is an amazing business model for our banks, less so for us. So as you've gleaned, getting ahead is not about timing an interest rate drop. It is not. It's about having a really clearly defined strategy that is bespoke to you. It's about increasing your pace of saving, making sure that you have an optimal debt reduction structure, and unlocking future wealth creation opportunities. Here's how you do it. Universal reality. 99% of clients that walk through my door, and I've been doing this for a decade now, I have seen lots of clients. For the vast majority of clients, you are paying too much in interest on your mortgage. And I don't know about you, but I am not interested in making our banks any more profitable. I could put that money to better use. For you, what could that mean? A more comfortable retirement, travel, kids' education, more choice in general. It is a huge differentiator when you own a mortgage strategy. And I'm going to put some numbers around that for you because I have chartered accountant blood in me, but I think it's really important to clock in this environment. So the difference early repayment can make. So we talked about the average first home mortgage now being approximately 550,000 on a mortgage rate of 5.99%. If you pay it off over that 30-year trajectory, so again, there's no shame in that if that is what you're doing. That is what the vast majority of people are doing. So on that 550,000, you would pay 635,000 in interest. If you just plug away principal and interest, which is what we do as our default position. If you can get mortgage free in 10 years, that is the benchmark for my clients. You will pay 181,000 in interest. The difference is 453,000 that you do not have to pay back to the bank. That is a large quantum of effort in terms of working. That is such a big number in terms of wealth creation options into the future. It is a non-negotiable for all of my clients that we have a robust mortgage structure and strategy. And if I'm honest with you, a lot of my clients have higher mortgages. Again, the, the margin of savings gets higher the bigger the mortgage balance. So looking at an $850,000 mortgage, you pay it off in 10 versus 30, you save yourself 700,000 of interest you do not have to pay back to the bank. So how do we do it? Simple. Bish, bosh, bash, right? Why aren't we all doing it? We are human, life intervenes. There is nothing surer. For the vast majority of people, we don't have a plan, we do not know what we're capable of. And in the absence of not knowing, we do what we've always done, hoping for the best. And we're accountable to no one. What should a financial plan look like? What should we factor in? So it's really important as we craft this together that you acknowledge your starting point. What is the problem you're looking to solve? Are you trying to get mortgage free on your property? Are you looking to sort retirement? Are you looking to help the children? Or maybe all of the above. Really getting clear on that problem is important, as is how long do you have? If you are 60 or if you are 50, there are different options available to you. You have to clock that because often there are windows of time to take action because many strategies are not open to you infinitely. You've got to understand your behavioral tendencies around money. In terms of financial success, 80% comes down to behavior, 20% strategy. My job is to marry them both to make sure you execute and reach your potential. And everyone is dealt a different hand. I absolutely appreciate that. But it's how do you play your hand? Often people will come into my office and they will say and they will share, this isn't my bag. For some people it is. And I'm convinced I'm not where I should be. And I think it's incredibly brave to come along to a consult, to lay your life bare and say, could I be better? So I think that's a really brave thing to do. But I also know, as a financial strategy who has been in this industry for a very long time, what you have done in the past is no indication of what you are capable of in the future. So for most of us, it comes down to three things. And I'm going to unpack that further with you. So step one, cash is king. You've got to maximize the cash that's left over. For a lot of us, we spend a lot of time focusing on our top line. What do I mean by that? So your top line is what you earn. So we often think the thing that fixes this is to earn more money. But in all reality, the more that you earn, the more that you spend, and the more you disconnect from your finances. For a lot of my clients, they are incredibly clever. They work hard, but it's kind of like they're this hamster in a wheel. They're pedaling so fast, but they are not making progress. So maximizing that cash flow piece is really important. And to do so, we need to understand how you operate around money and your starting position. Then we craft the plan thereafter. And this is a really simplistic analysis, and there's more to it, obviously. But in very broad terms, some of your natural tendencies, and your natural tendencies are your default position if you have no reason to try harder, in effect. So we've all got these kind of natural tendencies. They can work for you, and some can work for you, and sometimes they can't. And sometimes the combinations neutralize the benefit of the others. So, for example, you could be a saver. So your natural inclination is to save money, but you're also a safety warden, stuffing money under the mattress. So you're really good at amassing cash. You are not good at growing it. And that is a cost to you. And lots of my clients, I saw some awesome clients last week who have traveled overseas. They've got a very large wad of cash. They've been working for many years, 40s. They don't have a property. They cannot pull the trigger on buying a property. So they have a huge stash of cash, which quite frankly means they are locking a loss, and they have a window of time to execute on opportunity in terms of property market, but they are not. So again, think it's an advantage, but if you're being too cautious, there is a cost to that. And I think for a lot of my clients, they are plotters. So they can shop a little, they can also save a little, and they think that if they work hard, they keep their nose clean, and they keep on doing the doing, they're going to be okay. That is not the truth because they are not being purposeful, and that makes them a dreamer. I wrote an article this week that was published in Stuff about some beautiful clients that I saw from Wellington. They bought their first home in December 2021, peak of the market. And she works in the public sector. He is in construction. The value of their property very likely has fallen by 25%. They had a 20% deposit. If they were forced to sell that home, they would still owe money to the bank. And she survived 2 rounds of redundancy. There were promised more rounds in the coming year. They are floating right now from a cash flow position, but they are on a knife edge in terms of sinking. So if you are identifying as a plotter, my challenge to you is, could you survive a curveball? Because I need you to. That is a non-negotiable in terms of your plan. And your cash position is super relevant to me in terms of where you are starting from and where I need to get you to. Because I need to get you to flying. How do I define flying from a cash flow perspective? I need you to be saving, clearing debt, investing about 20% of your after-tax income. That's where I need to get you to. So again, really important to understand how you operate around money. That crafts the design of your plan, but also that opening position tells me what I need to do to make sure I really maximize your resilience into the future. And knowing your starting point helps optimize cash flow, certainly. But this is a really interesting point. On average, Kiwis fritter 15% of their net income. Little bit of overspending, a lot of paying too much interest to the bank. My job is to find that and put that to better use. For my clients, I usually use an analogy of cups of coffee. I'm a bit of a coffee fiend, must be my age and stage required. And so for me, my first cup of coffee of the day, I am riding that caffeine wave, lots of bang for my buck. Second cup, not quite as good as my first, but still pretty good. Third cup, I feel a bit sick, admittedly. So my optimal level of coffee drinking is 1.5 cups. Anything over and above that, I'm doing for the sake of it. And we fritter across so many things that we do. And I think if you look down that list there, does it really make you any happier to pay more for utilities? I'd argue not. And when you are being purposeful, you have that beautiful feeling of I am making the most of my position, kind of like Marie Kondo. It's like cleaning out your house, getting a skip, and getting your house in order. That is what we are doing. And in doing so, we are strengthening that foundation and we are finding money that we can chuck against that mortgage to increase the pace at which we pay it off. And I had a phone call from a client who didn't sit in on the initial session, and he was deeply worried about, he loved everything that I had crafted in terms of strategy for him and his wife. But what he was deeply concerned about is that he would be miserable. And I promise you, if you have a plan that is based around deprivation, you would last 5 minutes. I know that, you know that. The skill is understanding and challenging yourself in terms of what are the things you spend money that make you feel happy. Let's earmark space for that, and everything else we channel as productively as possible. That means you sustain your plan. And for me, those are your non-negotiables. So really think about that. I allow at least three. And for me, that is my travel, it is my kids' activities, and my coffee. Do not take them away from me. I will not execute on the plan. Again, everything's about balance. And what I reiterated to him is my job is to facilitate you living your best life, not your most smallest. So I encourage you to do the maths around that. 15% of your net pay will be slipping through the cracks. It's a big number. It is a big number. Let's make the most of it. And in doing that, we've just got to get rid of short-term debt, non-negotiable, key action, get rid of your credit card. It is a behavioral economics principle that people spend about 15 to 20% more than they would otherwise by using credit cards just because it is a less transparent form of payment. You know, you swipe your card, have I paid? Who knows? Who really cares? You'll do better when you don't use credit. I hear you arguing, I pay it off in full every month. I don't care. You spend more, get rid of it. So maximize that cash surplus. That is really foundational in terms of what comes next. Not about you working any harder. How do we be smarter with what's left over? Let's really understand that. Step two, let's get rid of debt. It's just dead money to you. But you've got to understand the difference between productive debt for investment and unproductive debt against your home. Unproductive debt we just need to get rid of. Re-emphasizing that point, it is not about interest rate, it is about the pace at which you can pay it off. That is the differentiator of success or not. So there are lots of different mortgage options, and I'm going to distill this soon in terms of what I recommend you do in light of the OCR. But as you've gleaned, there are lots of elements of a good financial strategy, mortgage is really important, but there are other components to make sure that you have a really holistic plan and which allows you to leave no stone uncovered. But here are your options. So you could just straight refix, your loan comes off and you fix it for a new rate with the current lender. You could refinance it. And I would really be encouraging you to look at this, particularly if you've got all of your debt coming off, it's fixed term. The benefit of refinancing is you get to clean slate that mortgage. You also have the benefit of getting a cashback, which again can help mitigate the higher interest rates that we're still paying regardless. But also it can leave you open for other wealth creation options in terms of leverage and investing. So we'll speak to that soon. A lot of my clients will restructure their lending, so they will ensure they have that really optimal structure. So it's not just a straight refix, it's how do I make sure that my structure will serve me into the future? I get asked this question a lot, and I've done these webinars, presentations. I've sat in many, many client meetings, and often I get asked the question, what is the difference between revolving credit and offset? What is your preference? I prefer revolving credit, unequivocally. A revolving credit, some of you will have it, some of you will have it and won't be using it correctly. Other of you will be looking blankly at the screen. A revolving credit is like a really big overdraft, so it's floating. The beauty about a revolving credit is if you have excess funds, you can plonk that against the mortgage immediately, offsetting the balance, but you can re-access it if you need it. And I really like that about the revolving credit. That re-accessing piece means that you are more resilient, but I also like the cash flow impact of only paying interest on the amount outstanding. It's important to clock that you will be paying a floating rate on the amount that you owe, but not on the available balance. That's really important. So if you can clear a revolving credit within a calendar year, the effective interest rate is halved. So if you're floating at 8%, for example, and you clear it, your effective interest rate is 4% because you're only paying interest on the amount outstanding, not that available balance. An offset mortgage, whilst similar, is different. And the devil is always in the detail, and it's asking the right questions. I had a client this morning tell me that the bank, BNZ, doesn't offer the revolving credit mechanism. That is not correct at all. He was asking about it in relation to his trust. So again, it's understanding what are the right questions I should be asking. So the offset product is not offered by all banks. BNZ, Westpac, effectively what that does, it means very similar to a revolving credit. If you have 100,000 of lending that is sat in that offset, so it's floating, you owe 100,000, you can offset that with 100K of savings, for example. It's fully offset, you don't pay interest, fantastic, but you will still pay that balance off over the remaining term. I don't like that. I think that is cash flow inefficient because for my clients, we're attacking unproductive debt versus debt where there is no impact. So I'd much rather pay off debt that's attracting interest versus something that's paid off. That makes zero sense to me. So that's unpacking the difference, my preference. In terms of structure for my clients, we use a optimal mortgage strategy written by one of our professors at the University of Auckland. Essentially what that does, it's like 8 pages of calculus, but what it does is it cuts your mortgage into savings or debt reduction goals. So every year you've got a piece you can attack over and above what the bank wants you to on your terms, not their terms. And we have a balance of debt that we're attacking, and then we fix the remainder for certainty and lower interest. Again, we rinse and repeat. Really good mortgage structure, but that is bespoke to who you are, your capability, and what your goals are. So today's OCR announcement, what does that mean for you? So we've got a 0.50 drop. Everyone expected it. 4.25 to 3.75. Great. Um, Good news is the Reserve Bank expects us to get back to neutral, 3% faster than they had anticipated because the economy is a bit poked. Great. It can take a few weeks for banks to get competitive following an OCR announcement today. So for lots of my clients who are floating, generally speaking, they're keeping their powder dry for a few weeks in terms of fixing. For a lot of my clients, they're looking to split lending to mitigate risk, especially if they're being quoted any interest rates with a 4 in it. That's getting really attractive. So we've had Westpac pre-OCR announcement offer a 4.99% for 3 years. That is very attractive. Interestingly, they've withdrawn it, but they are going to keep it open for another couple of days. ANZ today has came out with a 4.99% interest rate for 2 years. That's attractive. And so again, for me and my clients with a really optimal debt reduction strategy, we want to pay it off faster. We're going to do that via that revolving credit mechanism. And then we're looking to split lending across those fixed terms, which makes sense in terms of our circumstance to secure certainty, a lower interest rate, and then we jog on. Getting the best interest rate for as long as you can is great. Ultimately, that's not the thing that makes the difference. You think back to COVID times when we were paying 2, 3%, good old days. Did that mean we made more progress? No. It means we spent that money on spas, home improvements. It did not translate to progress. So really important to lean into the structure of debt. It's the finding of the extra money to get ahead and making sure that really serves us into the future. We are not going to see those 2 and 3%ers again. So if you're holding out for that, you're going to be holding out for a really long time, paying a premium floating. And if we ever did get back to 2 and 3%, the economy would be in the toilet, so you'd have other things to worry about. The right approach for you is entirely dependent on your personal circumstances, but you got to catch these key principles and strategies as they relate to you. It gets you ahead. It's the difference between you and your family being okay or not. Financial progress is never linear. It's not. I love that saying. What is it? Anyone can have a plan until they're punched in the face. I think it's Mike Tyson. Never a truer word has been spoken. And I have walked the path with my clients, some of them for a decade now, in my strategist role, and I feel like we've gone through a lot. I think of my pilots and my air crew in COVID. That was a punch in the face. Could we see that coming? No. But I was so proud of them because they did what needs to be done up to that point. They had a buffer, they had the right insurance, they made progress. So they had options because holding your line is really important. And when things are hard, for my clients, we lean in. And if we get a headwind, we lean in because we know that sooner rather than later, it will go away. And we need to make sure that we have made that progress before things are tough. And plot twist, whilst getting you mortgage free is important, it is not the end game. You cannot eat your house. And if that is the only thing you focus on, there is an opportunity cost to that because you are leaving equity on the table in terms of what else you could do. Step 3, and I'm saying this and delivering this as it's sequential. It's not. They layer over each other. So we've got that cash flow piece, we've got that mortgage structure and strategy. But whilst you clear debt, step 3 is we always grow wealth. We have to do that concurrently. Really important. And leverage is one of the wonders of personal finance. We've talked about compound interest as it relates to debt, but leverage is really important. And you leverage two ways. You could leverage through a business. Your effort plus any employee's effort gives you a greater gain, or you leverage through property. You put in your money, the bank puts in their money, and you keep 100% of that gain. Mathematically, that outperforms on average most asset classes by 250%, not because it's amazing, it's just because you have acquired a bigger asset that is going up in value. So I'm going to bring this to life for you with some amazing clients we've worked with for a long time now. Luke and Jake. You always have favorites. You try not to, but you always have favorites. So mid-30s, mortgage 700K, term 30 years. Remember, there is no shame in having that trajectory. Some of my clients are doing much better than that. I can always increase the pace of progress, though, always. So they came in with a 30-year term. We think they said we can get them down in 12 years, get them mortgage free. What they actually did is we got them mortgage free in about 2021. So they did it in 4 years. Please clock though that this wasn't the perfect line that is evidenced in that graph. They purchased a car, they renovated their home. I think there was like dry rot or something or other. Homes, it's always something. They got married, they traveled overseas because, again, this is not about you living your most vanilla life. It's how do I live my best life? They've also purchased 2 investment properties, which we are super proud about. But please know they overcame a lot. There was some redundancy, a health scare, etc. So the key lesson I want you to catch there is don't wait until life is perfect. Don't wait until everything is known. If you wait, your window closes. And in my experience, it is very rare for the stars align. It's just about understanding your position and playing your hand as best as you can. My job is to get that asset position working as hard as possible for you, because for most, it just doesn't. It just limps along. They're fine, but they are not making the financial progress that they deserve. And again, I'm just trying to illustrate here the impact of paying your mortgage earlier in terms of retirement. So the average Kiwi buys their first home at 36 and it takes them 30 years to pay off their mortgage. Again, evidencing great, you retire at 65. In this example here, KiwiSaver, so they pay off their debt, great, on one hand. They get the pension, but they need to tap into that KiwiSaver to live a good life because it's very hard to live on the pension. So they run out of money at 69. That is a terrible retirement. If you can get yourself mortgage free faster, so again, remember for me and my clients, I try and have that baseline of halving your mortgage term. I'm really aiming for 10 years if I'm honest. But again, we play with the hand that we're dealt. If you get mortgage free at 55, it means that you can increase the pace at which you save, which means you run out of money at 80, not 69. That is a good retirement. It's not good enough for me and my clients, but it's still a good retirement because for me and my clients, I need to get you to at least 90, preferably 100, but I'll settle for 90. And what this graph is telling me is I've got between 55 and 80 to sort a problem. That is a long trajectory in terms of wealth creation. And there are lots of options for growing wealth. We do not play favorites. It is what is the right strategy for you to ensure you hit your goals. So that might be managed funds, property, term deposits. In all reality, a lot of my clients do a little bit of everything, but what are we leaning into? Age and stage. Clocking that can't save your way to wealth. You just can't. A strategic plan is crucial. It's like the saver who has amassed a lot of cash that's just sat in the bank doing absolutely nothing. And they argue it's safe, but to me, you're just banking a loss by not executing on a wealth creation strategy. And again, adding in that dynamic of bridging that gap, we need 500,000, which feels like a big number, but you've got a long trajectory to make it up. So this client might buy an investment property, they might invest in funds to get that money working as hard as possible for them, but I need them to land at 90 by hook or by crook. And from a numeric perspective, if you do the maths and your retirement gap is bigger than 300,000, you're very likely going to need to lean into leverage to bridge it. You just do. And you need to know how much you need for retirement. You do. We've started talking about mortgages. Of course we have, but my job as a financial strategist is to have a longer line of sight than you do. And how I anchor any financial plan, and I work with a myriad of people, youngest 24, oldest 84, and everyone in between. The anchor of every financial plan is that we figure out together, what does a good life look like to you? What does it cost you? Because in reality, we need to be executing on a strategy that grows that asset position to a point that feeds that when you're no longer working. Woohoo! Um, Everyone has a different number. We understand yours, and that is the strategy we execute on. Are you on track? You got to understand that, because being on track and where we're aiming for, that dictates the strategy we lean into. But there are fundamentals: cash flow, mortgage. What else do we do to make sure that you land where you need to? And often we need accountability. For most people, you do better when you work with somebody else. You lift your game, you do what needs to be done, and you get there in the shortest amount of time. I really like this quote. I read it last week and I asked my team to put it in this webinar tonight. Working hard is important, but working on the right strategy is more important. A great strategy can deliver exponential results, but of course, the best strategy is worth nothing if you never get to work. 0 to the millionth power is still 0. So let's go through key takeaways. Lower interest rates are great, but they don't get you ahead. You need to understand your tendencies, who you are, who you're not, because that is the environment that we need to make sure that we put in place so that where things are hard, you make better decisions. What is your capacity for progress? And how does that feed the strategy that is right for you in terms of mortgage structure, wealth creation, places where the real gains are to be made? Knowing and doing are two entirely different things. We lean into execution. That is the thing that moves the dial. And we never lock and leave a strategy. You cannot have a strategy that is set in concrete. It will quickly become irrelevant to you. And accountability, like lots of things in life, is really key. I often think that is the overall differentiator for my clients in terms of success. Of course, I know structure, of course, I know strategy, but it's the working with somebody in terms of doing what needs to be done at the right time, that is the differentiator. So this is where we come in. We will ensure that you don't just know, you do. We provide the accountability to make sure you achieve. The strategy takes into account who you are, who you're not, and we'll monitor it to ensure it's always fit for purpose. We can help you if you want to invest in you and your future. Take action with or without us, but please take action. Don't just listen to this information and let it go in one ear, in one ear and out the other. I called it out at the beginning. The current circumstances present an opportunity to get ahead. For most people, they won't take it. We have seen it before. So if you know you need a nudge, this is it. So we'd love to invite you. I promised it at the beginning. We would love to invite you to a diagnostic consultation with a coach like myself. It's a 90-minute session. You jump on the financial scales. We'll diagnose together. Where are you at now? Where do you want to be? Are you on track? What are the strategies you should be executing on to do better? That is usually $400. But tonight we've discounted that down to $149. Absolute bargain. You just need to take advantage of that tonight. It is a one night only offer. If you go to our website, enable.me/mortgage. What is that? Mastery, Katie. Um, just use your camera and take a photo, and the QR code will do its thing. If you happen to watch this webinar, you've got a recording, would still love to see you, would love to offer a discount, but discount will be $249. That $149, we can only offer that tonight. So Jess, lovely producer, questions, hit me.
Hi, Katie. Thank you so much for yet another incredible presentation. Cool. I will go through. So we've got one question that has come through live tonight. So I'll ask that first. Do you work with people with an average income?
Absolutely. Yep, absolutely. Remember, it's not what you earn that gets you ahead, it's what's left over. So huge income. We work with very average incomes up to very high earners. Again, that's never the differentiator to progress. We think it is, but it's what's left over and how we execute on that. So yes, we do. Good question.
Oh, thank you. So the next question is coming through the chat. Sorry, I've just minimized by accident. Back. So this one's in from Kaza. Is part of the session advice on structuring your mortgage?
Yes. Yep.
Right.
Yeah. And it's an important component. It is not the only component. And you would have gleaned that already. So it's important to get a really good mortgage structure and strategy. That is not the only thing that will get you ahead. And part of my job in those sessions is to make sure we leave no stone unturned. So we'll be looking at that KiwiSaver piece, insurance, etc. Just again, just to make sure everything's fit for purpose.
Nice. Thank you.
Welcome.
Next question. So do you have any tips for deciding between paying off the mortgage versus starting to focus on other investments? Is there a balance or a sweet spot relative to income and debt?
Yeah, I would say if you have capacity in terms of, yeah, let's use an example of an investment property. If you are paying down your mortgage and you have capacity and the bank will give you lending to buy another property, you should. End of. Would that mean that you would take your eye off a really robust debt reduction strategy? Certainly not. That is a risk mitigant in terms of your strategy. But again, you need to lean into that wealth piece, but making sure you do it really clinically. It's not about buying any property, it's what is the right property for you, because you have to have the ability to hold it. So again, there is there is a piece around that that we unpack in that consult as well, and I'll give you my best advice around that.
Nice, thank you. Another great one from the comment section. Are you guys, well, I'm part of it too. So are we independent or affiliated with any banks or products?
Yeah, so we're not working for a bank. I'm not trying to sell you a product. We are independently looking at your position and understanding how could you do better.
Thank you. Another one that around the consult and what it
Yes.
entails. So, what is the output of the 90-minute consultation? Is
Mm.
it an initial plan tailored for our circumstances?
Yeah, so that in that 90-minute session, I will tell you exactly the strategy you should be executing on to get it ahead, whether you work with us thereafter or not. So for most of our clients, I'll put a number around that fritter piece. We'll talk about how to structure that debt. I will tell you what you are capable of in terms of how quickly you could pay off the pace of that mortgage if you have one. Some of my clients don't, some do. We would also talk about what else we need to be doing in terms of wealth creation, because that is age and stage dependent as well. So closer to retirement, that's harder to lean into property. Sometimes that window closes, not necessarily always. So we will go through at a very high level the key actions you should be executing on to really get ahead.
Thank you so much. The question box is firing away, so I think we're going to run out of time to answer them all. I'll pick two more, but sorry if we don't get to your questions. We
Sorry.
have a great onboarding team that you can give a ring tomorrow for any more information about the consultation. But so the first of the two questions,
Hmm.
how does one navigate child support that takes up approximately 25% of take-home pay?
Yeah, it is a challenge. But again, as part of a plan, you just really need to understand cash in, cash out, what's left over. And lots of people have lots of different obligations. It's just understanding again how that fits into your plan and what's left over and how do we utilize what's left over to the best of your ability going forward.
Thank you, Katie. And the final question of the evening. What conversations do we need to have with our current mortgage broker after consulting with you?
So it depends. So for a lot of my clients, they don't necessarily work with a broker. For a lot of my clients, some do, some don't. Again, I'll tell you exactly how I would like my clients to structure debt based on untested numbers. We work with clients in programs to really refine that. So for most people, it is understanding, well, what are the rates available? Should I refinance? Should I not? We'll cover that off in the session, but those are the conversations that are generally had. For a lot of our clients, we work really closely with Squirrel, who help facilitate that lending. Really interesting. I got asked a question this week. What's the difference between a mortgage broker and what I do as a financial strategist? So again, a mortgage broker facilitates that lending. It's quite transactional versus we look at that mortgage structure and strategy as part of a broader wealth creation strategy. And it's more long term in terms of how we work with our clients. Great question.
Thank you, Katie. So again, sorry if we didn't get to your question. Please send us an email tomorrow if you've got any questions about around how our consultation works. Our team will be happy to answer. But in the meantime, I'll hand it back to you to close, Katie.
Great. So thank you for listening. Really hope you enjoyed this consult tonight. Seize this opportunity. Please do. These windows close. We're in a high interest rate cycle again into the future. This is your window to make progress. Please seize it. All the very best.